comes down to computers communicating.
The information superhighway can be a confusing mix of on-ramps and off-ramps.
Bitcoin is worthless artificial gold.
Is it still rat poison?
Probably rat poison squared.
We need to get into the world of, okay, this is actually foundational technology.
What the Internet of Money does is it creates a single network which can do a microtransaction to a gigatransaction.
The Internet is going to be one of the major forces for reducing the role of government. The one thing that's missing, but that will soon be developed, is a reliable e-cash.
Welcome back to Final Settlement, everyone. Today is February 11th. It's a Tuesday. Gentlemen, how are we doing? I'm joined by my co-hosts Michael Tanguma and Liam Nelson, and special guests today, Mitch Kochman, Chief Revenue Officer at Onramp. Very happy to have you on the show today. Lots of topics to get through, but how are we doing, boys?
Doing all right, all things considered. It's flooding down here in Texas. Had to move location so the internet could work. It looks like Bitcoin's price is flooding and bleeding out as well. We're in a bear market at 95,000.
Crashed to $95,000 per coin.
Yeah, so things are rough.
These are always a good time historically, though. So I'm
shop solidation.
Exactly,
a good time to add.
Exactly.
If I had any fiat to add, I would be adding here.
Yeah, when things are quiet, it's generally a good sign too. Don't want too many hyper bullish headlines all across the news. People need some time to digest. So all is good. Just kind of keep on chopping.
I'm excited to have Mitch on because Mitch has been talking our ear off for over a year now about SAB 121 being repealed and how the banks were rugging the industry. And once the banks had the handcuffs taken off, that we were going to go an up only. So I want to see if it's going to actually play out in that direction and what the latest is.
Yeah, I'm pretty sure banks are going to want to make money. So I'm pretty bullish about leveraging them to access new pools of liquidity for this industry.
I don't know how much banks actually like making money. I was listening yesterday. Bank of America, I guess, has $100 billion like on the books in losses. Is that right? From the
in what?
From the bonds that they hold.
Yeah,
that tracks.
Yeah, I mean,
Makes sense.
They like making money, but that's just generally been the wrong trade for them because they back in 2021, the move to get like marginal extra yield was to go out and buy 30-year assets rather than 1 to 3 month bonds that were yielding nothing. And so they wanted to make money that way, and they really like to make money. They just were caught on the wrong side of that trade.
We will get to the repeal of SAB and all its implications, but to kick things off, wanted to go through some news over the past couple of weeks, some topical headlines and deals that I think are worth covering. The first of which I'll pull up on screen here was Stripe acquiring a stablecoin API bridge for $1.1 billion. I think this is sort of just reminiscent of what we've been talking about for the past several weeks of because this new administration, Trump and his team, his digital asset working group, are seemingly very much leaning into stablecoins, and that being the vehicle or the avenue by which we really spread dollar dominance across the world and, sort of walk this fine line of continuing to kick the can down the road, devaluing the currency, but still maintaining reserve status by just spreading stablecoins all over the world. And so now you're seeing the Stripes of the world, I think, see the sort of posturing from the administration and say, we need to lean into this area. So any thoughts from you guys on this move from Stripe or the deal terms or anything else?
I mean, I think what I'm curious to hear, because I haven't fully thought out the position other than it's super bearish for all the Bitcoin companies that try to create cross-border products and solutions, because at the end of the day, those were built to move fiat independent of what the movement of Bitcoin is doing. They're trying to get dollars from one place to another. And this is kind of ties into last week's news with the Tether rolling over Lightning or whatever. But it's this notion of, well, if the rails are already figured out from Bridge, I would imagine has relationships cross-border. They've done compliance with different banks. There's already plumbing with the existing system, and then how do you transfer into stables on whichever blockchain? And there's a standard being formed, which Mitch, you said on the other side of this, on like an infrastructure perspective, it's really hard enough to go and explain this stuff to legacy institutions, but they can, if you can, again, help them make money, they'll buy into it. But then to have to go and explain why you need to do this on Bitcoin, a different protocol with a different it just doesn't feel, it feels like it takes out the air with a lot of these like pitches. And so I'm just curious, like Liam, I know you looked at a lot of deals even at your previous life, just, being a student of the industry, and how is that take make sense? Or do you think there's a different angle why people would use Lightning from a cross-border remittance perspective?
Yeah, I think a lot of times too, people are just, they already have enough issues with respect to tax getting money across borders that they don't want another volatile currency to be involved as well. Well, at a very broad sense in terms of all companies. So I think a lot of fiat companies that just want to have dollar treasuries will want to use this product, and it solves a need for them. I think there is a use case for some Bitcoin only companies that really want to have, their entire treasury in Bitcoin to get across borders. But at this point, it's just a little bit too early for mass remittances of Bitcoin across countries.
I broadly think that, when you've got large players like Stripe building on other chains, I think it is going to be harder to build these solutions on Bitcoin, at least initially. That said, when, over the medium long term, when, let's say Stripe's building on Ethereum here, if usage of Ethereum is going down, they're going to find themselves forced to go migrate this somewhere else. And ultimately, Bitcoin, we're picking up market dominance, picking up usage. It's the same, similar to my background in the infrastructure world of do you want to keep hopping vendors, or do you want to go with the strongest, most resilient one that you might have to pay a bit more. You might have to it might move slower, in some cases, but do you trust that your money's going to get there? And so this can be a cost benefit analysis for all these firms. I'm not surprised that they're going on another chain first. But no, I'd say in the short term, pretty bearish with this stuff happening on Bitcoin, at least the major players going to Bitcoin. But in the medium long term, very bullish. I think it's, in general though, and this is what I'd probably get into a little bit on SAB, but firm like Stripe that, what are you looking for? I'm looking to acquire, I don't have, the skills as much to, the proof of work that I've done this. I'm looking to acquire, knowledge, resources, technology that have proven out that they can move this money. This traditionally has not happened, stables on Bitcoin prior. So if I'm going to go acquire a firm, I'm probably going to acquire one that's doing this on Ethereum or Solana or whatever it is today, which is why I think they go in a direction like this.
Yeah, I think that's all right. I mean, I think the reality of the situation is that the vast majority of stablecoin volumes and flows are on these other chains like Tron and Ethereum. And to your point, though, Mitch, like I do think there's a medium to long term rationale for trying to build stablecoins on Bitcoin. We've seen early iterations and attempts at that, and the thinking really being like, do you want to build these dollar-based payment applications on a sound foundation that is going to be here in 50 years, or do you want to do it on the most popular one right now that might not be that in 10 or 20 years? Like that is, I think, the real crux of the question. And particularly if these guys are just going to go buy a player like this, with like a deal like this, then obviously you're going to go the route of a shorter term, like where's the volume today, right? Like I think because that's how you justify a $1 billion purchase of this company, is by saying, well, this is where all the volumes are, and we're going to build out capabilities to service these people today.
Yeah, I think like the value accrual where Bridge I think is interesting is like they have like regulatory framework, on ramps, all of the plumbing for different institutions. Like it's a like a liquidity game. So the more people that pipe into their APIs, you get more access points from bringing in dollars, and then it's accretive to the network. So I think that's interesting today because a lot of people haven't done it. But what I think is more interesting on the stablecoin side is at the end of the day, the value is not where the protocol it's being sent on, because it's actually the database that it's being referenced, because the protocol can just be turned off and you can move over the database to whichever one. So I think the question is like less, or the thing I'm less find interesting is what the rails that are being used. It's actually the mechanics and the integrity of the underlying asset. And how do you, what makes Circle, Tether, or if Onramp or whoever spins up a stablecoin that delivers some kind of like additional yield in like passing through treasuries. And then if something gets dislocated, what's backed up by BTC, maybe offers BTC on an annual basis to those wallets. Like that's how I think who wins, because that's a brand recognition and trust game, because that's why you're using those stables, not because of the rails that are used, because any of those, including Lightning, something could happen to a channel, but the assets are still a counterparty, or the counterparty is still the issuer. And so I think like that's the real interesting aspect of who can accrue the most value, is who builds the brand around stables that has integrity and is forward thinking on how do you bring in more liquidity so you can issue more stables, which you can get passed through more revenue and win. That I think is like the next version of stables, and why I would want to use one is I would look at who has the best kind of economics around it.
Economics, risk. I think we're very early into the productization of this stuff.
Yeah, I think that all makes sense. I mean, if you look at like Michael, what you're sort of alluding to is like the integrity of the underlying, i.e., for all these stables, like if they're just buying U.S. Treasuries, and then if you look at Tether, like they haven't historically passed along that yield, right? Like they're just keeping that themselves as profits, rolling a lot of it into BTC. But is your assumption that people will pass along whatever those yields are with respect to the treasuries that they're holding as the underlying?
Yeah, I mean, I guess going back to like the bridge, I guess their value comes because the people using them most likely have no idea who Circle or Tether are, or have done a lot of the diligence, maybe somewhat, but it's really like bridges their interface into accessing this and thinking through their capital movement in the same way that like they would go to Stripe and then plug in their bank accounts and they can move funds. They're getting access to that platform. And they'll be agnostic to what chain it's being used, like whether it's Solana or Ethereum. They probably don't even know, to be honest. So I'm like less interested, or even like maybe it does end up on Bitcoin because of the integrity over time. The piping's there. It's just not there yet. So like I can almost guarantee Bridge is not probably have integrations with anything Bitcoin related. And if it is, it's probably very like not a lot of liquidity. But the other thing that's actually more interesting, because if the APIs and that plumbing can continue to grow, well then like what's the moat around that? And there's something there, but then there's also how do you create a real moat around the integrity of the stable coin, and it has to start looking differentiated, because right now Tether's making X billions of dollars. There's not a lot of competition, but what happens when somebody gives back X percentage of those billions back to the end holder, passes it through via their digital wallet, and then also anchors a portion of their holdings into BTC. So it helps with if there's any like dislocation, there's a run, right? We saw what happened with SVB and Circle like 2 or 3 years ago, where the price started to dislocate. Well, if you have the Bitcoin backing it up, now you have higher integrity. And it goes back to like the free banking style of different banks will have different custodial relationship or custodial models. They'll also have different stable models. And so if we're going to live in a dollar denominated world for at least a while, you may need those dollars, and maybe you're whipping them around online. But if one's paying less interest or one's potentially seized, or the counterparty that issues that stable, there's assets are encumbered, right? Like it starts to look like, well, what are my dollars? Who's being held in this world, this digital native world? And that's what's kind of interesting, because now you have an opportunity to differentiate in the financial services and the stables that you offer.
No, that all makes a lot of sense. I think pivot to the next deal, a strong departure from what we were just talking about, where there's real demand for US dollar stable coins. This is a deal where, I don't think there's actually a ton of demand for what this company, Taproot Wizards, is trying to do. They raised $30 million. And if you're not familiar, Taproot Wizards has sort of pioneered or worked on Bitcoin inscriptions, which is effectively a form of NFT on the Bitcoin blockchain. And a lot of also sort of the undercurrent of what this group and others have been pushing is effectively vouching for, advocating for a Bitcoin improvement proposal called OpCat, which would enable a lot of different things, including what they want to do basically with these ordinals and NFTs and making them more usable, better user experience, things like that. What do we make of this? I also wanted to pull up here just to look at the volume of ordinals over the past several months. But while I pull that up, any thoughts on this deal, guys?
It's pretty easy to say, but raising money with guarantees or soft guarantees of a change to the Bitcoin protocol is probably not a viable strategy long term. It seems like a promise that they can't make, and so it's going to be very difficult for them and their investors to monetize this kind of on a hope. It's definitely something that I would want to stay away from personally, but we'll see how this plays out.
Yeah, so I have pulled up here just inscriptions over time. You can see there's a good amount of activity back in 23, and then really fell off for most of 24. Slight blips over the past couple of months, but not what I would deem sustainable demand for ordinals and inscriptions.
And even just to piggyback off of that, you can see how far these inscriptions have fallen. And it's kind of just the same thing that we're seeing with the proliferation of all these different meme coins being raised, which is essentially there are so many different ones at the moment that you can gamble on which ones are going to go up short term. But in the end, it's mostly a zero-sum game. And essentially back in 2017, with the mass adoption of ICOs and a lot of these meme coin craze, and when that started back then, there's been kind of a bit of a decline in all of these other coins, just because people now have a better way to bet on leveraged Bitcoin, which is essentially through the public markets, which is significantly easier, buying MicroStrategy or buying calls or puts on MicroStrategy, which just have massive amounts of volatility, which I think is mostly the demand for all of these different things like Bitcoin ordinals and all these different meme coins. And so I see a lot of demand for all of these different products declining long term, but I'd be interested to hear your guys' opinions as well.
Yeah, I don't follow, the ordinals and all this stuff very much, but I didn't pull this data, but I can almost guarantee you that is easily a top 5 single funding, or top 10 and probably top 5 single funding round for a theoretical Bitcoin company. There's no shortage of affinity scams that tie to Bitcoin. They've happened since its very existence. And when you see somebody invest $30 million in something like that, it's ultimately telling you that they've gotten some economics on the next altcoins that are going to get spun up, and how do they get access to. It's just similar to what we've seen in the altcoin space with Multicoin and these other VC firms, that they're investing because they're going to get access early to these altcoins that they're going to be able to dump on retail.
Yeah, I think that's well put. The sort of what you're alluding to around the perverse incentives of something like this, where in order to really profit from it, you need to be effectively the earliest to it, and then basically capitalize on the late liquidity and dump on retail. So we've seen that with altcoins, with meme coins, with NFTs, and with inscriptions. It's kind of the same story.
So, I mean, to just looking at the fundraising round a bit, they're building probably applications to go build, and interact with this stuff. So, it's probably, they're trying to build the pickaxes to go create this world, which, there will be plenty of, rugging retail and early investors that are making money on it and whatnot. But I think they're trying to build the applications here. My stance on this stuff is like, I don't pay attention to it, but I'll defend the right to do it. It's an open source protocol that broadly they can use it as they wish. I don't care. It's not what I want to focus my time on. As long as we're not seeing the network getting flooded with DDoS attacks.
I think that's pretty much where I land on it as well. Like I don't have like a super fundamental issue with it because I am sort of a free markets maximalist. So if people want to get rugged on these things, go for it. But raising 30 million on this idea, I struggle with. I mean, from an investment perspective.
So, I mean, it's once again, it's not my cup of tea. But that said, the president just launched a meme coin. Like, there's a market for this stuff, unfortunately, for better or worse. And, people are always going to be after, or seemingly, environment that we're operating in, where, inflation's ruining, their buying power. They're going to be after that 100x return, unfortunately. We try leading them, informing them to go a different way. But until that mechanism changes where, inflation isn't attacking their buying power, like there will be something in human nature that's going after that return, that's looking to gamble. And unfortunately, like, look, these people are building the infrastructure to go provide that. And I think that's what this is.
Yeah, but I think what's more nefarious is that, again, it goes back to the affinity scamming on Bitcoin, because we saw this with the layer 2 stuff, that he gets a pass because, he worked with the president or whatever, but Bailey and all those guys just like investing in all this layer 2 crap that is effectively has a token that's not needed to dump on retail. This is a cousin of that. Stacks is another great example where we talk with clients that would never touch quote unquote altcoins, but then are happy to invest in Stacks because they believe there's some fundamental utility token around that. That's where the problem with this arises, is like Opcat, Bitcoin, whatever you're going to derive from it. Liam showed the not really the volatility, but ultimately, like, it's like all altcoins. It gets heavy when the market's out there. Similarly, like Steppen is just my favorite because, when everything's hot, the price is up. And then when liquidity goes out of the market, it's just dead. It's zombie zone. And so that's what you're banking on in a $30 million investment, is to get access to when the price is running so you can dump, and then you can effectively get your bags packed from whatever the investment was.
The next one more piece of news before we jump to the next thing, but I thought this one was interesting, just in the sense of so SoftBank made an investment in Cypher mining, and so why I thought this was particularly interesting was, so SoftBank, they've made some other Bitcoin and crypto related investments in the past, most notably in 21, I believe they invested in Digital Currency Group, DCG, and the parent company of Grayscale Trust. And then they also invested in FTX, which they wrote to zero. And so this, I think, is the first time since that FTX investment that they've gotten back into the space with an investment. And I think it's particularly interesting that they decided to invest in a Bitcoin mining company as opposed to something in broader crypto. Any thoughts on this, guys?
I could jump in. I do agree, it's a sign of things to come. You look at a firm like SoftBank, what are they typically after? They've, extremely long time horizons. win the mining space, in the short term, even medium term. You've got countries mining, you've got actors that are not primarily focused on economics that are getting into the mining space. It's an extremely competitive area of our industry. But that hash rate, when you look at the medium long term, when blocks begin to fill up again, that's it is absolutely worth something to be able to guarantee the fact that you've got a space in blocks, should you win the block reward. So I'm not shocked. Folks at SoftBank are looking at the mining space with that long-term time horizon. It definitely matches up to how they typically invest.
Yeah, I also wouldn't be surprised if they have their ears to the ground all across the world and understand what's going on with hash rate and understand that there are likely nation state level hash rate accumulation going on right now. So I in that sense, I think this deal and investment make a ton of sense if that's what they are seeing on the ground, which is what we've heard anecdotally and is sort of rumored to be the case right now. So in that sense, it makes total sense. The most positive signal to me was that they're not investing in some crypto company, they're getting into Bitcoin mining. So it does seem like a shift from where they were 2 years ago, basically.
And another thing is, this is also kind of going into taking a step back. SoftBank also was one of the investors in the Stargate program, which was the $500 billion AI data center program, essentially trying to build out the infrastructure of data centers that is needed to host all of these data centers to run the AI programs for these companies. And I believe that their part of their investment in Cypher is just understanding, okay, they are a massive data center company that has a bunch of access to cheap power, and potentially they are looking to shift them to skew a little bit more into AI rather than pure play Bitcoin mining, because there's a lot of demand for that pretty much all across the world. They, as companies look at the Stargate program, which is essentially building out a ton of data centers that are competing with Bitcoin miners to get the same low cost electricity contracts, they are increasingly going to run into, why does this industry consume so much power? Are they actually generating any economic returns that make sense from this? And does it make sense to really focus as much on investing in data centers to help run services for AI, or will there be a benefit to just mining Bitcoin with that excess power if we're not using all of it? I think we're just going to see some more industry leaders become a little bit more familiar with the industry as a whole and dip their toes into the industry as well.
Yeah, I think that's exactly right. I think with the nuance, a little bit flip there, is they have the downside protection of mining as long as they make the right investment, and then it's a call option on the acquisition. Because everything I've seen, and I'm not close to mining, but is that the co-location or acquisitions, it's more economically, it makes more economic sense to turn off the miners and actually co-locate to run models. And so it ties into Bitcoin mining being the canary in the coal mine for cheap cost of energy, because it's a lot easier, it's more modular to go into the darkest, deepest corners of the earth to find low cost energy. And once you've proven that out, now you can actually co-locate and start to put GPUs to run the data sets for LLMs. And so I think that's the trend we've kind of seen with Core and some other firms. And that could be an angle like you're referencing, that they're in Stargate, they have to start looking for more power sources to go and deploy these GPUs. And Cypher could be one of the first parts of that play.
Yeah, it's a really good point. It feels like that co-location and sort of blending these two industries of Bitcoin mining and AI data centers is certainly a trend that's occurring, and this could almost be viewed as a two birds, one stone situation, effectively. Okay, well, that's all I had for news.
One thing, we can't give SoftBank too much credit on that, because they're wild in the sense that they can produce these crazy returns, but then also we've seen their write-offs or their investments been their write-offs there, but then also like, I don't know if you remember, they bought a shit ton of Bitcoin back in like, I want to say 2020 and then sold it all like in 21, right before the run up, something crazy. Like, so they don't have a fundamental grasp on like, at least previously, on what was happening in this industry. So you got to take everything they do with a grain of salt. Yeah. If you look it up, you'll see there, you can kind of track it.
Interesting. I didn't realize that. Okay, switching gears a little bit. Mitch, Chief Revenue Officer at Onramp. You joined us how long ago? Is it been about a year? Yeah, from previously BitGo and IBM before that. You've been on some of our pods in the past, but it's been a little while. So maybe for the audience, it would be helpful just to walk through sort of your background, what you've done in tech and infrastructure, and then ultimately crypto and Bitcoin, and really what led you to Onramp. I think that would be a helpful place to start for folks.
Yeah, it feels good to be back. I've had a baby 6 months ago and dusted off the mic for the first time since baby was born. But my background came from IBM, spent a little over 11 years there, largely servicing major banks, helping them with their infrastructure. My last role there was I led IBM's relationship with JP Morgan and saw under the covers, massive infrastructure stack supporting Chase Bank and JP Morgan operations. Had a moment where I looked at my son and said, do I want to be helping Jamie Dimon automate jobs, or am I do I want to inspire you and be a better example? So I went to BitGo and spent almost 2 years over there, but came 2 months before FTX, and that 2 years was largely spent helping I'd say nearly every Bitcoin company and a number of crypto companies as well make it through all the challenges of 22 and 23. Started with FTX, but then went to Silvergate, went to Fortress Trust, Prime Trust, and BitGo being safe harbor for many exchanges during that tumultuous time. August 2023, Michael came to BitGo with the idea for multi-institution custody. I'd say 5 minutes into the discussion, I knew right away this is something that, number one, BitGo had to be a part of, something, number two, that our industry needed, because the single party custody system had failed. And then my primary part of my job was being safe harbor for situations when it did fail, but very much knowing that we needed some sort of better resiliency for our industry if we're going to get the adoption that we all hope to come here. So I grokked it pretty quick, and I went to Mike Belshie, BitGo CEO, said this is something we've got to be a part of. So we met for a couple of days, talked through sort of disruptive forces here, but painted the picture of if multi-institution custody is the future that our industry is moving towards, BitGo being the best key agent possible in this model ends up being very fruitful for BitGo when there's more copycats for multi-institution that come into the industry. BitGo having the reps that they've done this before, they'd be the first client or first key agent that they would jump to to spin up a new instance, a new custodian. Got on board. I spent 6 months standing up anything from onboarding to legal agreements and getting BitGo where we needed to be from a support perspective, and ultimately had the choice of if I knew in my heart of hearts multi-institutions what the impact that I know, I'd say what I wanted to work on to go make this industry more resilient, to make my time well spent. I could have went to Onramp and ultimately made us, and I did, I guess, the Notre Dame and multi-institution, make this a success so that other firms, key agents, capitulate and come into the model. There are copycats, on their way. But you make this a success, more come. or I could have sat there at BitGo and tried to drum up interest to go be, to create more on-ramps. Ultimately, success is going to breed followers. So came to Onramp, spent a year here as chief revenue officer. Broadly, what I do on a day-to-day basis is we've got this multi-institution custody framework for how to hold keys, and it's building products and services around it for the three demographics that we largely serve: individuals, and building products around that being IRA, lending, trade. Their institutional clients and our enterprise offering, broadly creating products and services for those client bases. So that's what I've been spending my time for the last year.
Awesome. Appreciate you walking through that. I think if you could go back and think back to the time at BitGo and cleaning up the messes of the FTXs of the world, and this is before the idea of multi-institution custody had been incepted into your brain. At that point, what did you think was best in breed, right? In terms of custody and security, we had there's this notion of qualified custody, which I think sort of got blown up in the sense of there were quote unquote qualified custodians who didn't fulfill their obligations to a certain extent, or something went wrong. And so how did your view of custody and security sort of evolve from the time of cleaning up FTX to realizing there was another way with multi-institution, distributing counterparty risk, reducing single points of failure? But what is, I guess, putting yourself back in those shoes, what was the most secure custody at that point? And what was the big unlock for you being okay, there's a whole nother way to do this, basically?
Yeah. So I'd say at the time, what was best custody? It was making sure you were in deep cold storage. Market proved over a number of years that if you've got a hot key, it ultimately will be exposed through some sort of security vulnerability. So that was certainly a perk to BitGo. Slower withdrawal process, but broadly that helped keep funds there. Strong balance sheet. It does protect against risks like that, which is why your Coinbase, your Fidelities, your BitGos of the world, Anchorage as well, tend to do better here. But I'd say that and really track record. But that said, if you're looking at what a post SAB 2121 repeal, what that means for the industry, if we're just looking at single party custody, all that is stuff that the banks are going to catch up to. They've got the balance sheet. They're going to having a speed is not necessarily a requirement by the U.S. banking system. Deep cold storage is going to be the way that they go here. Whether they go build it themselves over a period of time, or much more likely moving to acquiring the talent and services. That's banks, if sitting in those shoes in 22, 23, that's where this industry was going. And it was the change was the eye-opening model of it didn't need to be this way. I was talking to major firms that are holding largest Bitcoin holdings in the world, and their methodology for choosing custodians was go after the biggest balance sheet and write terms in the language that say, should you go under, my claim is first. Mm-hmm. And or you're backstopping me with your funds, not what's in trust. That's not a way that this industry is sustained. You need something better, because this is the first industry where fundamental loss of the asset means it actually goes away. It's not just installing a row in a database. So that's why multi-institution was so eye-opening. It's because all these losses, they're the reason why our industry does get a bad name. Why there is resistance, from those who are just following the stories on FTX and reading major news headlines, that not necessarily even seeing things like the ETF inflows that we see every day. You build trust by not having these events happen, by proof of work and time that between losses. So on the other side, what that looks like is we can have firms go bankrupt and customer funds don't get impacted. That's the world I wanted to go build, and what I didn't think was possible in 22, 23, outside of just having a major, a large balance sheet secure this stuff.
Yeah, that's a good way to summarize it. It's effectively, how I talk about the unlock of multi-institution custody is it adds fault tolerance and redundancy to a custody setup for really the first time, outside of what you just described of like, you hope their balance sheet is big enough. You hope you have some language in the contract that could cover your ass in basically a single point of failure being exposed. But like that doesn't scale. It doesn't work for the average person. Like not everybody, has the ability to negotiate those types of contracts. So like you did just need a fundamentally different architecture for the setup. And I'm glad that you latched on to that idea early with conversations with Michael. And it's been fun. It's been fun to build out sort of what this looks like in real time. You sort of alluded in there to what we've referenced a couple times around SAB 121 being repealed and this idea of banks getting involved in custody. I guess open it up to the group, broad thoughts on what that looks like. Do banks build this themselves? The expertise needed to custody private key material is very different from any other asset they've ever custodied. So do they go hire people to do that? Do they outsource it? Like we saw basically with the ETF issuers just saying, hey, we're just going to hand this to Coinbase. Do they do something like that? Or do they just outright buy some players? What are the thoughts there? And sort of what is the trajectory here for banks to really get involved in a material way in any of your views?
Yeah, I would love to hear Mitch's opinion here because he's obviously got a lot of experience here, but would also love to hear, especially on your view of like what you think they'll get right, how you think they'll do it, and more importantly, do you think that they'll learn from any of the mistakes of the 2021 cycle? Because people really have short memories, and even like Mt. Gox is very distant memory at this point. So was just curious on your thoughts there.
Yeah,
there's a ton of. Go for it,
maybe
Michael.
before you go, Mitch, because I want to hear that, but I think before going into that, I think laying the scene for what is available for banks, because it's actually a very small window. If they have to establish a position, right, they're kind of caught flat-footed because historically they were told not to touch this, and a few have kind of had research groups or built in-house things, but they haven't been able to turn them on. So if you can lay out like what are even the players that could opportunistically partner, and then how do they think about build versus buy before even going into like, I think that's also important how to think about counterparty risk. But that'd be helpful just to like lay a little bit of the scene of like what's going on in the space and what are their options.
Yeah. So I worked with banks for quite a while. Fundamentally, who's involved in is vital for the thumbs up, thumbs down of whether a business gets approved. It's the risk department. It's always risk. And if I'm sitting, I can imagine the conversations right now. You've got all these banks do employ people. On the digital asset side, where they've got these teams that have been researching and doing the work on diligence on companies, diligence on chains, and where they may want to be. What these people haven't been doing over the last couple of years is moving money, holding keys. If I'm a risk department and I'm going to turn on Bitcoin custody, crypto custody, do I feel comfortable with a framework that is not battle tested, that is not actually custodied Bitcoin, that is not people who have not been in the trenches onboarding and doing these asset transfers? That's a scary thing if I'm sitting in a risk department right now. So what do I expect to see? There's been some M&A in the space. Broadly, some of these banks or custodians buying wallet technology. I think that's going to massively increase. Looking at like the Stripe acquisition, the economics of what it costs to go buy some of this stuff compared to what that could mean to these banks from a revenue perspective. There's a mismatch there. It's not. There's certainly economies of scale that they pick up because the access that Bitcoin firms and while some of these numbers are big, as far as reach to compared to like major banks and even some of the regional banks, it's the scale is hard to comprehend, and I've seen those numbers on the IBM side. So I think we're in for massive M&A. I think you'll see some products that roll out Q1, Q2 of stuff that's been cooking up, but I think it's probably end of 2026 before these banks do have the comfort to offer the products that ultimately like need to come. That said, once that does happen, goodness, are they going to be formidable players? From the balance sheet, from the relationships that they have, with wealthy people, with really everyday people too. Trust that they've built up. But that said, too, like as we've seen with the ETFs, I think many of them are going to first see this as a revenue opportunity, but then also a potential opportunity to go gain new clients. And they're pretty ruthless on the competitive landscape. So I do think on the technology side, on the strategy side, they're going to be looking for the cheap strategy credits to differentiate, to pick up new clients. So I'm fascinated to see what plays out over the next 2 years. Like I said, it's going to be a ton of M&A. The deep pockets of this industry it's hard to fathom. I've seen software deals, for a year run rate run a lot more than some of what these acquisitions are going to cost. So I do. I think the access that they have is going to, totally blow away the valuations of some of these firms because the tech's going to be so important to gain.
It's an interesting dynamic that probably naively I didn't think about. It's like there's only so many players you can partner with if you want a custody, but ultimately if they buy somebody, it's going to be like their custody offering to the market, which is kind of a problem when you think about specifically from like community banks and other banks that have been disintermediated by the big 4 or 5 banks. Now you have to use them for custody of assets, which is just like an interesting dynamic. And then to your point, Mitch, that's a very like interesting acquisition framework when you have like a BitGo that has over 100 billion in AUM. Coinbase just came out with over 700 billion in AUM. So there's like 2 angles. You're like acquiring the assets, and it's like venture on assets because the assets grow because this asset class is growing. So that's an economical, like you got to like model that out. But then you're also buying, like to your point, there's only so much talent in this space because you need the tech, but the tech doesn't actually matter if you don't have the operational excellence and understanding how to manage this stuff. So it's a very, it's super fascinating. I think 2026 is kind of ambitious as we know how slow they may like force this stuff, but there's just so much complexity that you have to layer in. So yeah, it's wild.
I think they're going to be forced though. Like when one of them comes out with a Bitcoin product, they're going to lose clients because they don't have a Bitcoin product. So I think it's weighing the risk of actually, offering it, and not having the chops to necessarily do that versus, the FOMO and, the real business drivers of, we're losing clients. This is stuff we're going to have to, be talking on our earnings report calls, that we need to go bring a product to market here. So I think you're going to have both sides of the coin, which is why, I think acquisition is absolutely the way they go because you can instantly get the credibility and instantly, referencing a BitGo, 11 years of battle-tested wallet technology is a much different, animal than, for a risk department to go digest than, zero or starting up. So I think that's the only way that I see firms actually, these larger banks going.
Yeah, it's a good way to frame it in that there's risks of you want to do this stuff right, and you also don't want to necessarily overpay for assets that are going to be bid up because there's only a few basically players, versus there's also probably clear benefits to being early and being a first mover in offering a product or offering different services. So that will be a balance. I mean, I personally expect that kind of deal activity like end of this year to really start. Like I would be surprised if it doesn't start until 26.
Well,
because
just
just the way.
integration.
Yeah. I thought he was talking about just like the M&A activity in general. I think we could start to see that, this summer.
I think we see it now.
Yeah.
Truly
the discussions are happening.
3 to 6 months. Yeah, I'm sure that they're happening now. But everyone's trying to I'm sure it started in November. They knew this was coming, and it's frantically working on the plan of what does phase one look like, and what is our strategy for the long term.
Which is all it's very interesting on the timing, right? So like if you assume deal making happens throughout this year, and maybe they go live with products in 26, it could just be very interesting timing depending on like if Bitcoin cycles continue in the fashion they have. That could be right around the time that things are selling off and they're launching a Bitcoin product. Do they then do we repeat what happened a few years ago where everyone then pulls back from whatever they were about to launch? That could just be interesting timing, or there's no such thing as cycles anymore and it's a super cycle, boys.
Yeah, I don't think that it's a super cycle. I think the industry has a lot more credibility than it has in the past just because of the timing of the ETFs, and that people have made like 100% plus returns if they bought like immediately when they launched. And both like big financial institutions are making money and their consumers are making money. And so it could be really bad timing if the banks launch right into a bear market or at the very top of the bull market. But I think the ETFs have legitimized this asset class for the foreseeable future.
So, I mean, at the risk of saying the Bitcoin cycle is dead, because I don't necessarily think it is at all, but thinking about the reach these banks have, when these banks turn on custody, that's not the bottom of the top of a cycle. It's the ability to go like this is the supply and demand game, and when when demand or you're going to have so much new demand that then feels comfortable, with the idea of buying Bitcoin, holding Bitcoin, that they're marketing machines. We saw it with the ETFs turning on and pushing these Bitcoin products. There's no way that's the top. And we could experience the top beforehand, and we get pushed up. I'm not here to make price predictions or whatnot, but we saw with the ETFs of what happens when new demand gets turned on, and we were going to see that again, with the banking industry.
Yeah, and there's a confluence of things happening here. Like there's the natural stuff around Bitcoin being destigmatized and all of that, but then there's this reality, and I know there's a lot of bearish people on gold, but like inflation is going to be persistent. There's a lot of things that have to happen to get out of this situation with, the Treasury, Trump, all the things that we know, like the writings on the wall that inflation runs. And so scarce assets, the 60-40 is up for grabs. And like, what does that look like in the future? So these banks are going to naturally have to think about new structures as far as how do you custody a model portfolio? And so Bitcoin's obviously part of that. I think gold will also be a part of that. Obviously, we're seeing what's going on with the gold markets, and there's going to naturally need to be better consumer products for gold because people just don't. I think that's the thing we just forget about. It's like not everybody just apes in. It's like Bitcoin's the thing. I'm on 100%. What if you're 70 years old? What are you going to do? Like put 20% in Bitcoin and then deal with negative yielding bonds. Like, sure, some people are going to do that. Maybe they want to buy gold, but they're going to naturally need a better product for that, where they can get better protection, they can get better visibility. So I think there's just structural changes happening to the financial landscape when it comes to like assets and wealth preservation that these banks are going to have to catch up to. So like, kind of fits into both what Brian and Mitch was saying. Is there's going to be this natural persistent bid. I think independent, like we'll still get the volatility of cycles, but they're just going to be higher. We're going to be at higher bases in the low and the high.
100%. And it's this idea of just like additional passive flows coming into Bitcoin that are just going to be kind of set it and forget it. Either some additional money going into your Roth IRA or any type of IRA just going into Bitcoin, whether it's the ETFs, if you can have it directly with banks, there's just going to be a kind of passive bid that typically happens with the S&P or any other similar financial products that will. I'm not saying this is the death of cycles, but I could see one where there's potentially one that's not 80% drawdown if there's more of a passive bid for a long time with these ETFs and banks that are custodying it and just like doing the marketing of Bitcoin for it.
That passive bid could also just dampen volatility in general, though, because of rebalancing that would occur, when asset prices increase.
Yeah,
I also think like we're trying to compare this to like what we saw in 24 with the ETFs, but like I think the magnitude and scale is just going to be entirely different, because even just looking at ETF flows, like yes, they're the most successful product launches of all time, but like they're barely even turned on at a lot of financial entities and wirehouses, and so we're genuinely just scratching the surface of like those untapped pools of demand that want exposure either through a product like an ETF or they want direct exposure custodied by their bank. I think when that really gets turned on, whether it's end of this year or 26, like I think it's hard to compare what we've seen with the ETFs to like what the magnitude of demand and capital flow could be from that actually being like fully turned on.
There is a crazy amount of anxiety, I personally feel, because like we kind of know the future because we've already lived through it. Like everybody, even in Bitcoin that were in early, have seen the volatility, the cycles. When we talked about ordinals earlier, like that stuff's existed in Bitcoin forever. You just have to like rinse and repeat, and it comes in a different narrative. In the same way, counterparty risk and education doesn't just, there's only proof of work. You can only get it by either learning from somebody and accelerating that, or ultimately having to touch the stove and go through it. So it's like the anxiety comes from where we know kind of where it goes. We know what we're building. We know what the consumer, the individual wants, which is important because that's who holds all the Bitcoin. But then we also know how Wall Street and individuals are going to build and how they understand omnibus structures. And we've seen this with like the ETFs and the products and solutions they do, and they're going to be ripe for gaps and losses. So we just have to you kind of know directionally how this all goes. And then in the meantime, you just have to like sit around and stay alive and help as many people get it right until it gets to the other side. And maybe you guys have different opinions, but just like all the conversations we have, everything I've seen, there's too much of a gap in what we know and what we've seen, and then what the rest of the market doesn't. And you can isolate that to Bitcoin, and everyone listening or here on the pod knows, like, you go pitch somebody brand new and they're like, well, what about, quantum or whatever? It's like, it's going to come up, or the rebuttals, the things, and everyone has to go through that progression in the same way, like most institutions and most firms are going to naturally have to go through that until standards are formed. And so like, it's an interesting situation to be in, to know that like what Mitch said is coming and it's true, but at the same point, it's going to leave a lot left. And that's effectively what this podcast and, the education's about, is like, not only what we do, but then if you're wanting to build in the space and you understand the space deeply, that's the alpha, or the gap, is understanding Bitcoin, but then thinking through what is commercially viable products that the market will absorb, because our stance is the market's not going to absorb people holding, plastic devices under their mattress for very long. And it also isn't going to be JPMC holding all the Bitcoin. And so and those two shouldn't be like very controversial, but they kind of are, that Bitcoin's going to be $500K or $1 million, and everyone's going to be fine with their inheritance plan with a treasure map. And so now that it's like, well, what do you do? How do you build around that?
I think with the the anxiety that you speak of, I'd say if we've learned anything, it's that this world we speak of, it's all playing out faster than I think any of us could have anticipated. And, if that if that cycle and, that perspective continues, what does that mean? Obviously banks are going to be getting into this industry. Obviously they're going to have, larger, these are large exposure points, and there will be attacks, from, we got massive honeypots of Bitcoin and client data. There will be losses. There will be issues there, or, potential attacks, may not be successful, but the vectors are going to be there. So what do we do now about it? That's what we're doing every day of, there's 21 million of these things, and it's helping clients go secure it and secure it for their families, and, create a fault tolerant solution that, if we can get clients to demand something like multi-institution, something like having, on-chain addresses that are apparent, the more that becomes the norm, the more we prevent issues like this playing out and ultimately people getting hurt. So, it's credence to what we do at Onramp. It's what I want to be spending my days doing is ultimately helping people secure their wealth, and creating the systems that ultimately lead this industry, that we end up in a better place and hopefully feel less of the pain that we know ultimately will come because we've experienced them before.
Yeah, and maybe even worth taking a step back, because we kind of glossed over the fact that I might be wrong here, but I think the majority of the banks are going to end up adopting some kind of proprietary multi-party computation system, whether they acquire or set up an instance. And they'll do that for a number of reasons. One, because a lot of them have been commercialized to sell to banks, but two, because this ties back into the education of banks are going to look at a diversified basket of cryptocurrencies and digital assets, and they're not going to be able to leverage multisig for all of that. And so they're naturally going to draft towards what is the all-encompassing solution. We all know, if anybody's done any diligence, it's an inferior solution. It generally gets thrown out with the bathwater when you secure Bitcoin in that environment. So that's a whole thing in itself that we're going to have, that's just going to be a thing where banks are going to adopt an inferior custody solution and offer, and also adopt all these cryptocurrencies and have to figure out how to sell to them, explain them, educate them. And it's kind of a crazy situation, because Leishman's posted about this a lot the past 2 weeks about they've Coinbase and these other firms, they've already done and played this out, and they're not going to learn from it. It's Coinbase has a problem, because what was the coin? I feel like this past weekend got as quick as it pumped and they try to get it listed, it was already just bleeding out. There's so many, but it was new.
Yeah.
I think it was Jailcoin from
Barstool, exactly,
like that.
Exactly. Yeah.
Kraken had that next day. So which is the perk you can do at MPC. It doesn't work on the multi-sig side. But that said, if that's where they think the money is, they're in for a very rude awakening, because that's where the short-term capital is. But when you're talking to serious people, they're looking for true cold storage. They're looking for the actual auditability that you get with multi-sig. So look, I do think ultimately though, some of the M&A we've seen very early has been on the MPC side, but I definitely think there will be plenty of voices at these firms that demand both on the client side, but also on the actual the talent of the banking banking industry employs. They're going to demand multi-sig solutions. So I'm not naive to think that they don't come, but off the jump it may not.
Brian, I'm curious, because there's one thing on the technology, but even ahead of that is the education. We talk about focusing on education. Well, it sounds like the softest value prop is actually the hardest, because it's hard to distill these concepts, but then ultimately, if you have an educated client, it's a client that you've taken care of and all the things associated with it. If these firms are selling all this stuff that their clients are losing funds on. It's, to Mitch's point, short term. It's short sighted. But if you're building a long-standing institution, and the reason I asked you, Brian, is because you were at a previous private bank that was around for, I believe, over 100 years, that you can only get away with so long selling this stuff and being wrong before you leave, because usually people are exit liquidity in the space and they're not getting educated. And the best analogy I have, because it's not perfect, but it's like if you were trying to build Instagram or a photo application in a digital environment and you went to Kodak, it would be nonsensical. I almost feel it's very similar if you're going to go to a traditional bank to try to get a specified or specialized asset management with a bank, because it's fundamentally different asset across the board.
Yeah, I mean, I think that's right. I think my prior firm, Brown Brothers, would, they've been so reluctant, even when I was there, and since I still, am in contact with some buddies there. Like they haven't moved anywhere effectively in terms of digital assets or Bitcoin. And I think that they will be last to move effectively. But it comes back to what you're describing of like, this is a firm that was founded in 1818. They've built their entire reputation in business around being a trusted, long-term oriented partner for their clients, and offering a basket of cryptocurrencies that go to zero against Bitcoin is how you like destroy trust in a pretty rapid fashion. So I think the Brown Brothers of the world, I think, will be late movers to all of this. I'm hopeful that some of those folks, institutions like that, will take a more principled approach, and before they do anything, educate themselves, or at least attempt to, and get to a place where they're going to offer something, but it's not going to be enabling a casino effectively. Which I think, if the risk that some of the existing TradFi players run today is they try to move quickly and they offer something that is effectively, a skin on Coinbase, if that makes sense. Of you're offering a basket of cryptocurrencies, various exposures, and you're not really providing any expertise or knowledge around what differentiates all these different assets, and you're just opening up the floodgates effectively. It's very short term oriented, and runs the risk of destroying credibility over the medium to long term. So I think that's exactly right, and it'll be interesting to see how these different banking players play this effectively. Like how do they sort of balance these different trade-offs and enter this market in a way that doesn't destroy their reputations in a couple of years.
The way I explained it to an RIA yesterday was we're like in mid 1990s. This isn't perfect, apples to apples, but it's like we're 1990s and you have an opportunity to get your clients in Amazon, or you can decide to get them in Amazon with also a bunch of other things. And when the blow off top happens, because I kind of feel like that's where we're at. We're pre like 2000 bubble. I think this next cycle will be that. And then we'll kind of come out the other side with the blue chip. And then we'll still have, Ponzi's, but it'll be like less tempered. The standard will be established around how to do custody. But between now and then, you're trying not to rug yourself and go into pets.com and whatever else was part of that froth. And so it's like you guys get to make the decision, but we're letting you know, like, there's a fundamental difference between Amazon and these stocks in the same way there's a fundamental difference between Bitcoin and the rest of these cryptocurrencies.
Make no mistake, 80 to 90% of these firms are going to offer every dog coin and whatever the heck they can make money on, they will. And ultimately, it'll be their reputations on the line. Years later, people don't forget, these decisions, but they're going to go grab the money because it's certainly there. It's the reason why a lot of these crypto exchanges offer, jail stool coin too. Like,
what's that old saying?
The demand's going to be there.
Your reputation's my margin.
Love it. Look, we're going to see it play out. They're going to make the same mistakes. So, I just be prepared to go see a Dogecoin logo on Bank of America or, whoever else turns this stuff on, because it's going to be there.
Mitch has been trying to get us to support
I
Ethereum, hence the bullishness for altcoins.
I'm out. Look, but Bitcoin dominance is like, I throw that chart to anybody, my former peers at BitGo. It's very clear that serious people are seeing through the noise. And the strategic reserve news, certainly helps our case too. There's front running that's certainly happening, and that definitely, I think, fuels the Bitcoin dominance case. But I'd say serious people understand it. The question is, what is going to be the motivation that drives this banking behavior? Are we building the products for the serious people, or are we maximizing short-term revenue? And both those answers could be the same. I'm not sure. I'm not sitting in their shoes, but I'm excited to see who does make the decision for Bitcoin only or nearly Bitcoin only, compared to ultimately the rest.
Yeah, it's an open question, but I think it's the right one. Yeah. We're a little over an hour here, boys. Anything else anyone wanted to raise or bring up before we rip it?
I was just looking through any notes to see if there was any topical things. I think the only thing, without sharing too much on our plans, is like, at the end of the day, the biggest insight for me, and it kind of ties into this and the strong feeling of where this goes, is because Bitcoin's an emergent asset, you have the majority of individuals holding it, so roughly 70%, and this ties into what Mitch is sharing about like having the right financial products, the right things built. Individuals that have carried the asset for that long have figured something out, which is you have to keep it offline, severed from the internet. And so ultimately the only way to get them to differentiate or change that position means that has to be a step function improvement. So not only do you have to improve on the custody layer and provide redundancy and resilience, but then you also have to be able to provide financial services, because unless you're holding this asset till you die and passing it on, you may want to get access to inheritance, which is a part of that, or lending or trading, or just there's a whole slew of other things that you would need. And so the banks and the firms that build that are going to be able to win those clients. So it's going to be a market-driven approach from the bottom, not the top, which is historically completely opposite of everything we've ever seen. So it's even hard for us to wrap our heads around it. But that's how I think we all see this playing out. And that's the opportunity for individuals building the right way, is because BNY can turn something on, but it doesn't mean people are going to go move their Bitcoin there. There will be, because of their brand and their name, but there's still going to be large holders. There's still going to be people. And then when counterparty risk happens, those holders are going to flee, because it doesn't matter if it's BNY, BitGo, Coinbase, and you can put a whole slew. They don't know the difference between their custody and FTX or another firm. So when all that goes bid and counterparty risk, people flee. And so that's when, better products standards are established. So I think that's like the caveat to all of this, is the banks won't drive this. They won't have the nimbleness or the taste for what's needed in the market. And so that opens up a huge opportunity that I don't think we've ever seen before. Usually assets are driven top down, or financial products are, and that's a huge opportunity.
You mentioned a point that I hadn't really thought of on the banking side, and it's something that, for better or worse, something we've took advantage of here at Onramp, is most of your single party custodians, your BitGos, Coinbases, Anchorages, they build products for broadly the institutional space. And why is that? It's because everything besides Bitcoin, primarily, the largest allocations sit with institutions. They seed, many of these token projects early on. They, over the long term, dump it on retail. But they build their products. BitGo, Coinbase, Anchorage, they build their products for, for the institution. It was a business-driven decision. But at Onramp, our first use case was the individual. Why? The chart that Michael just showed, 70% of that Bitcoin sits with the individual. Made sense to go build them products and services. So while it's 10x better than, the existing, single party custodial landscape, many of the clients we're talking to, have never talked to a custodian before. They are either sitting on exchanges, sitting in collaborative custody setups, or sitting on single party, single ledger, Trezor, cold card setups. They've never been talked to about risks they fear every day with things like inheritance, things like loss of funds, things like the personal safety risks, and that a lot of the success we've had is because we're actually reaching these clients that have very much have these needs that they've never been spoken to that by anyone in the custodial landscape, which going to the banking side, this is what they've lucked into is primarily they've got plenty of entity clients of course as well, but banks have the individual relationship. They're going to build products for the individual. I think they're going to end up in just by nature of the relationships that they have, like they've got a gold mine here and an opportunity to reach a client base that is not like the same success we've had at Onramp is reach a client base that has not been spoken to. So I'm really excited to watch products for individuals in this industry develop and be creative, because quite frankly, that's where the Bitcoin sits, but a lot of the innovation has not been there.
Yeah, it's very well said. If anyone wants to learn more about what we're doing at Onramp, our products, our services, please reach out to any of us or visit our website to schedule a consultation to learn more and see how we can help you. But with that, we'll wrap it for this week, boys. Thank you, Mitch, for joining us, and see you guys in a couple weeks.
Thanks, guys.
Thanks for listening to this week's episode of the show. If you found the information valuable, please share the episode with a friend or leave a rating on your favorite podcast app. All the links we discussed in today's show will be in the show notes inside your podcast app. Before we finish, a quick reminder that Onramp Media is for informational and entertainment purposes only, and nothing should be construed as investment or legal advice. Regardless of where you are on your Bitcoin journey, we'd love to hear from you. Visit onrampbitcoin.com/contact to schedule a consultation with one of our private client advisors.